Hey everyone, Nick here. When I left my first job, I had to figure out what to do with my 401k. It seemed simple at first, but it isn't. There are many factors to consider, and there is no clear best option for everyone. Screwing this up can be very costly. I've done a lot of research and condensed the information into this decision matrix of options versus trade-offs. Doesn't that beautiful decision matrix make you want to smash the like button? We will walk through the trade-offs step by step, including one that has allowed people to keep millions even though they declared bankruptcy. By the end of the video, you will be able to use this decision matrix to make a more informed decision. There are 5 options we will briefly discuss, and then we'll get into the trade-offs. Option 1 is to leave it. You can just leave your old employer 401k as is and do nothing. Option 2, you can roll over the 401k to your new employer's 401k. Most employer 401k plans will accept rollovers from other 401k plans, but you can check to verify. Option 3, you could roll over to an IRA, an individual retirement account. This is the default option most people recommend. Option 4, you could roll over to a solo 401k. This is also known as a self-employed 401k or a KEO account. This is an option that very few people discuss. My understanding is if you make even $1 outside your job from, say, filling out an online survey, you are a sole proprietor and can open a solo 401k. Spoiler, this is the option I use, and you'll see why as we go through the trade-offs. Option 5 is to cash out. As far as I'm concerned, this is a non-option. Not only are you paying a 10% penalty, but you're taking from your future self. These accounts have great tax benefits, and you can only put so much money into them. Do yourself a favor and avoid cashing out. The one exception is if there isn't that much money in your account, it could be okay. Your employer may even do this by default if your account has a low enough balance. Next, we'll walk through each trade-off and start filling out the grid. I put a lot of effort into researching this and condensing it to the most relevant trade-offs for most people. While this is worthy of you smashing the like button so that this information reaches more people, there is the chance that I am not covering something that applies to your unique situation. Make sure to do your own research and consult professionals if needed. At the end, I will briefly mention some additional trade-offs that don't apply to most people. The first trade-off is choice. 401k plans usually have little choice, but some offer a self-directed brokerage option where you can access nearly any stock or ETF. Otherwise, you're restricted to a list of funds the 401k offers, and they may suck. When you roll over to an IRA or solo 401k, you have far more options in which you can invest. Next is more control. When you roll over from a 401k to an IRA or solo 401k, you are taking control of your investments. While some 401k plans can be good and offer great options at very low costs, a good 401k plan can become a bad 401k plan almost overnight. I once worked for an employer that had a pretty good 401k plan at Fidelity with some of their great low-cost index funds. One day I was checking my balance and my account had been liquidated. Over $60,000 was gone. I had no idea what happened to it. Come to find out a week later that the employer decided to change the provider of the 401k. And they had gone with a horrible 401k provider that more than 50x'd my fees. It was terrible. I had no idea what happened to my money, and I immediately took control of it, opened up a solo 401k, and rolled it over. Another good option for control is once you're retired and you're taking distributions, the IRS requires 401ks to withhold 20% for tax. This may be more than the tax you owe, so you may have to wait for your tax return to recover that money from the IRS. When you have an IRA or solo 401k, you have more control. Another aspect of control is estate planning. Some 401k plans will distribute all of your funds to your beneficiaries if you die. This can cause them higher taxes versus an inherited IRA. These are several aspects of how more control could impact your decision whether you want to roll over from the 401k to an IRA or solo 401k. The next factor to consider are the fees. 401k plans can have horrible fees. These could be asset management fees, account maintenance fees, or just high mutual fund fees. The funds in the plan may also be actively managed funds, which typically underperform index funds. You could also lose a lot of your retirement money to these extra fees in actively managed funds. This is a benefit of rolling over, is you can get complete control and lower your fees. The next trade-off to consider is the Roth conversion. This can be a big benefit if you end up having some years with lower income. Let's say you want to retire early or take a sabbatical. You could use that low income year to convert some of your pre-tax retirement investments into a Roth account. Some 401ks offer a Roth option in in-plan conversions, but it is the minority. If you want to do Roth conversions, an IRA or the right type of solo 401k are most likely your best option. Next is asset protection. Most employer 401ks suck, but they have one big advantage. This is something most people overlook when deciding to roll over. This is a little complex, but it needs to be understood to construct a robust investment portfolio. There is a piece of legislation that has a big impact on asset protection. This legislation is commonly referred to as ERISA, the Employee Retirement Income Security Act of 1974. Now I'm going to read the law to you. Just kidding. As fun as that would be, we don't have time. I'll briefly summarize some of the legislation. One component is the government doesn't want you to be broke in retirement. So ERISA protects retirement assets from creditors. Unless it's the IRS coming after you, your 401k is generally going to be safe. You'll even be able to keep your 401k through a bankruptcy. Asset protection is a little questionable from an ethical perspective. If you owe someone money, you should probably pay them. While I generally agree with this notion, there are scenarios where I would disagree. I once heard a story of a grandma who gave her grandson a car. A couple months later, the grandson ran a stop sign and killed someone. That grandma got sued and lost her life savings. Was it her fault? Did she deserve to lose her life savings? We live in a very litigious society, and the laws don't always make sense. This is especially relevant to people that are exposed to more potential liability, such as doctors. In these types of scenarios, attorneys will just look for anyone connected to the incident that has money. If you have a lot of money, they may even just file a suit against you to try to get you to settle. If you have a solid asset protection plan and they see most of your assets are in an ERISA protected 401k, they probably won't even come after you. And trust me, these attorneys have ways of finding out if you have money and if it's exposed. Again, the ethics of this are debatable and they depend on the circumstances. But you can come out of bankruptcy a multi-millionaire if your asset protection is planned well. 401ks are very well protected due to ERISA. IRAs are also protected up to a certain dollar amount, but only in bankruptcy. The current dollar amount is around $1.3 million, and that is adjusted for inflation yearly. ERISA provides more protection in scenarios without bankruptcy. ERISA and the IRA bankruptcy protections are federal laws. To complicate matters a little more, in addition to the federal laws, each state has unique asset protection laws. Some states will completely protect IRAs and solo 401ks. Others have limits or don't protect them at all. You should research these for your state and when you move from one state to another. A fun fact is the state of Florida has an unlimited homestead exemption, so you could keep a multi-million-dollar house through bankruptcy. Asset protection is somewhat complex. If you do the research, you can probably come up with a pretty good asset protection plan yourself that would be capable of protecting a couple $1,000,000. As your wealth grows beyond that, there are some pretty interesting ways to protect your assets. You may want an attorney to help you either way, but retirement accounts are a great start and can help shield millions of dollars. If you're like me and would enjoy reading an entire book on asset protection, I found this book particularly insightful. It's called Asset Protection: Concepts and Strategies for Protecting Your Wealth. If you want me to make more videos on asset protection, please let me know in the comments below. The next trade-off is known as the Rule of 55. 401ks require you to be age 59 and a half to withdraw your money. However, the IRS has an exception if you leave an employer after age 55. There are some requirements to be aware of, which are out of scope of this video, but this rule could be used for the 401k of the employer you left after age 55. This rule would allow you to start taking distributions from that 401k before you reach the official retirement age. You'd be able to avoid that penalty and access the money a little earlier. The next trade-off is the backdoor Roth. The Roth IRA is very powerful, and it is a way to become a tax-free millionaire by retirement. If you make more than a certain amount of money, you cannot contribute to a Roth IRA. The limits begin at $125,000 if you're filing single and $198,000 if you're filing jointly in 2021. However, there is a loophole that allows you to bypass these income limits. This is called the backdoor Roth. This gets a little complex. My next video will be on the details of the backdoor Roth. For the purposes of 401k rollovers, what you need to know is this. If you roll over a pre-tax 401k to a pre-tax IRA, it can severely interfere with the backdoor Roth. Even if you don't make over the income limits now, you want to in the future, I would not rule it out. By doing this rollover to a traditional pre-tax IRA, you may impede your ability to do so. If you want to take control of your investments and roll out of the 401k, but you don't want to interfere with the backdoor Roth, the solo 401k could be a great option. This brings us to our next trade-off. That is simplicity. There are several aspects to simplicity. If you leave old 401ks around, it increases your complexity, so you now have extra accounts to manage. If you change jobs a few times, this complexity can really add up. Solo 401ks can also add complexity. They are not for you if you want simplicity. This is because you have to act as the plan administrator, keeping track of the contributions to your plan. And once your plan assets exceed $250,000, you'll have to file an additional form every year with your taxes. I think it's worth it for the backdoor Roth benefit. I'll probably make another video on solo 401ks. Just note, they can have other benefits. Now that we've covered options and some of the trade-offs for if you want to roll over a 401k and where you might want to roll it over to, there are some additional considerations that don't apply to most people. I'll just briefly go over a couple of them. If you're rolling over, you ideally do not want to take possession of the funds. This is because if you receive the check, you will have to meet certain criteria and a certain time frame of sending that check to your new custodian. Ideally, you want your 401k you're rolling over to distribute the check directly to the new account you're funding. You ideally don't want to take possession, but you may have to depending on the 401k plan, or if you're running a solo 401k, you are the plan administrator, so you'll have to take possession and make sure you meet those criteria. The next consideration is called net unrealized appreciation. This is relevant to people who get employer stock in their 401k. This has additional tax considerations, which I am not going to cover. If this applies to you, do your research. Another factor is called bonus shopping. Many financial institutions will reward you for transferring assets to them. This can be up to $2,000 or more just from transferring some of your assets over to them. If you're controlling an IRA or solo 401k, every couple years you could move it around to do this bonus shopping. This could add up if you want to generate a little bit of extra income from pushing some paperwork. Another consideration is 401k required minimum distributions. When you invest in these pre-tax retirement accounts, the IRS requires you to start taking distributions so that you'll pay taxes on the money because you're paying taxes when you take it out. So they want to try to get you to pay all those taxes before you die. However, if you're working for a company and you work past the age of 70 and a half and you're participating in their 401k plan, you don't have to take minimum distributions yet. This could be useful if you plan to continue working or potentially never stop working. In general, I believe rolling over is the best option. Between rolling over to a new 401k, IRA, or solo 401k, there is no clear winner in all cases. In my situation, I think the solo 401k is best since it gives me control and allows for the backdoor Roth. I recently started working at Google, and they have an amazing 401k plan. If I didn't already have a solo 401k plan, I probably would have just rolled my prior 401k assets into their plan. While it would give me less control, the plan has great investment options, and they're actually lower cost institutional shares that aren't available to the average investor. This lowers my expenses even further. It would still give me all of the other benefits, including ERISA protection. If you work for an employer with a great plan like this, I would consider just rolling into the 401k. Rolling over to an IRA can be a great option if you want simplicity and you don't plan on doing the backdoor Roth. Maybe you live in a state with good asset protection laws, or you're willing to forego the extra ERISA protections. Let us know what you're thinking about the best option for you in the comments below. I'm happy to help and try to answer any questions. If you've got value from this video, make sure you smash the like button so YouTube shares it with more people. Also, don't forget to subscribe so you don't miss out on future videos. Later.